What up YouTube, Salvador Brigman here. Let's talk about how to get funding for a startup company. There are different ways to go out there and get funding. They've really evolved over the years, especially with the addition of technology. So I've been privileged to see the crowdfunding industry grow from an infantile industry that's really in the alternate kind of finance category into being one of the major industries of the world, one of the major ways that companies actually bring new innovations into the world. So my entire channel is about crowdfunding. It's about how to use Kickstarter and Indiegogo or equity crowdfunding to actually get funding from the crowd. So that's what I talk about a lot in my books, my podcast, my blog, this channel, etc. But there are also other ways to get funding. And I really want to share with you that crowdfunding is not always the best fit for you. You can go to these other channels, you can make use of these other financial tools to actually get funding for your company. So on today's video, we're going to be talking a little bit about that and also the most common ways that people actually fund their company. So there are different types of companies as well. That's something to be aware of. You know, an investor is not just giving you money when they're investing in your company. They're expecting something in return. More often than not, an investor is expecting either a financial exit of some kind, maybe you're selling your company, maybe another person is helping you do an IPO, you're going public on the stock market. There has to be some kind of like liquidation event, they call it, in order for them to cash out their shares. In very rare cases, you might be willing to do some kind of like profit sharing program where you're giving dividends to your investors, but that is pretty rare. The majority of people that are investing in a startup are looking for something, they have some kind of expectation when they give money to your company. So the way we can categorize these different types of ways of financing a startup are with the expectations that people have when they give you money. That's how I'm going to be differentiating between all of these different funding types. So the first funding type is friends and family. These are what you call the fishes, or the dolphins, I guess. They're very innocent. This is a very innocent funding type because your friends and family are not sharks. You know, they don't know necessarily a lot about business. They don't necessarily know a lot about your business idea or your product. They're mainly going to be giving you money or helping you or supporting your startup company because they believe in you or because it's an extension of the relationship that you have with them. Now, I'm not talking about like them donating money to you or something like that. I'm actually talking about them investing money into your startup company and you actually treating them like investors. You presenting the idea to them. You showing them when they can expect to actually get a return on their money and really treating them in that way with the professionalism that an investor demands or that you would treat any investor similarly in that way. So when you have friends and family, typically these are the first people that seed the investment for your business. So this seed investment could be anywhere from $10,000, $25,000, $50,000 and up. You might also have acquaintances, people that you've done business with in the past, previous employers, or people that have been following your career with enthusiasm and they know how good you are at what you do and they're willing to support this new business venture in exchange for some equity that they can cash out at a later point. So this is friends and family. This is the first investment round that is typical of most larger companies. I think that when you're going out there and you're thinking of including this funding type, it's a little bit scary because you don't want to lose your friends or your family's money. But at the same time, a lot of people later up in the chain, like angel investors or venture capitalists, it actually makes them feel better that you have a family and friends around because then they know you're serious about this business. You're not going to screw over your friends and your family. There's a little bit of social responsibility there. So that's the first type of funding. The next type of funding are more seasoned and sophisticated angel investors. So what is an angel investor? An angel investor is basically either a high net worth individual. So they have over $200,000 in earnings per year. They have more than $1 million net worth excluding their house. They're basically a rich guy who maybe got rich from doing his own startup and selling it, from doing his own startup and going IPO. Maybe he just has a very wealthy, lucrative job. He could be a lawyer or a doctor. He could be in finance. Whatever it is, this guy has money and he wants to invest in startup companies. So what an angel investor does is he'll seek out early stage entrepreneurs and early stage ventures and decide, okay, I'm going to support this company. I'm going to write, a $10,000 check or a $25,000 check or a $50,000 check. Quite frankly, angel investments can go all the way up to super angels who are putting in $1 million checks. You're sort of getting more into VC territory at that point, but you do have super angels or people that are contributing way more. The benefit of being an angel investor is that if that startup turns into something big like Facebook or Google or Uber, man, that dude has made it. Like he's very wealthy. By getting in early in a startup, you're not only going to get a better valuation, better price for the shares, but also it's going to appreciate a lot. So they want to hear that, number one, you have a good team that you're going to be assembling. At an early stage startup, there isn't very much confidence in the actual product because the product, as you know, can change a lot as the company gets going. Airbnb did not start out as Airbnb. Many of the successful startups that we see today actually did not start out with the original vision that they had. Groupon was actually the point when it got started, which was like this collective activist kind of a social rallying app. And then it transitioned into what is Groupon because it noticed the group buying behavior and the discounted coupons and stuff like that. So the common view when it comes to investors and also when it comes to startups in general is that as an early stage startup, you are extremely likely to change your product, even you change your entire approach as you're going. So while you might have a good idea, you might have a good vision as an early stage entrepreneur, really these angel investors are betting on you. They're betting on the team, they're betting on your skills, your resilience, your perseverance, that eventually you're going to hit it right. They're going to strike gold. You're going to come up with the right combination of target market and product idea and marketing. So they're really betting on you. So that's the most important part when you're conveying your pitch and you're conveying your message is that you have the right team, the right people, and the right market. And while your product is still growing and still improving, eventually you will get it right. So you have family and friends, you have angel investors, and then we're getting up there a little bit more. You're going to then have VCs. This is the next way that you can fund a startup company. A venture capitalist is representative of other wealthy people. So venture capitalists, in many cases, they do have some of their money in the pot, but usually they're actually investing other people's money and they're putting it into these different startup companies. So they raise a fund, $1 billion fund or a really large fund, and then they're writing, say, $10 million or $20 million or $1 million checks into different companies, depending on the stage of the company. It'd be very I'm only writing Series A checks, or I'm only writing checks to companies that are doing their Series C round when the business is way more mature. You have different types of venture capitalists, but the one thing to take away is that they're actually investing other people's money. So their strategy, their business as a venture capital firm is to invest in a lot of different companies and hope that one company just makes all of that back and more. That one company ends up being that Dropbox or that Airbnb or that other major tech company. They hope that one of those companies outshines the rest of them, and maybe a couple others do well, but usually only one in the portfolio is going to do extremely outstanding. So they recognize that going in. Now, that being said, at the same time, they are having to filter through many, many other companies out there. And the most common reason that they actually don't even look at your pitch or look at your company is that it's not VC investable. It's not something that is going to be a good match for their business. They just can't make enough money with it. While you could probably make good money with a deli or owning a small business, it's not VC fundable because they are looking for an ROI on their money. They can't put, $20 million into one deli. It doesn't work. You're confined by the actual limitations of the marketplace. So they need to be investing in companies that can scale and therefore they can get an ROI on the money that they have invested. So one of the common reasons why VCs just don't invest in your businesses, it's not VC investable. It's not going to get them any kind of ROI. The marketplace is not big enough. They can't see any kind of outcome where they would actually get their money back and more in order to function in order to support their business, which is as professional investors. Other reasons why a VC might not invest in your company, maybe you don't have defensible technology. Maybe you don't have a moat around your business that is defensible in any kind of way. So anyone out there can just go out there and they can copy what you're doing. That could be another reason why a venture capitalist doesn't invest in you. Could also be you, the person. They don't believe that you or your team have the temperament or have the skills or ability to execute on your grand vision. There are a whole host of reasons why a venture capitalist might not decide to invest in you, or why they might as well. While there is obviously science behind this, and you can prove that you have traction, you have customers that are interested, your business is growing, there's also a little bit of art to that. So that's sort of the traditional model of the way that businesses are funded in America. Now, there are many other ways that entrepreneurs go out there and get funding. So for example, using things like debt. Getting a small business loan from a bank, getting a loan from the Small Business Administration, using grants, if you're a minority, winning business plan competitions. These are other ways that you can fund your business. Typically, a small business that has capital infrastructure, they have a factory or they have hard goods like machinery, they're more likely to get a business loan or a restaurant, because in the eyes of the bank, it's much more likely that they're going to pay back that loan. And if they don't, they can always liquidize the inventory or the capital expenditures that went into creating that business. If you have a business that's a bit more in your head, or more of a service-based business, or something that's more catered to intellectual property, it's probably going to be harder to get a loan or a business loan from a bank, but they might lend you the money as long as you put up collateral, like for example, your house or other property you have. So many entrepreneurs will end up not being able to get a business loan from a bank, which is actually why they will use things like credit cards to finance the purchase of inventory, or they'll use credit cards to finance their marketing costs early on for their company. That is not something that I recommend doing, because you're going to be paying a massive interest rate, and also that's an added expense for your business. But I have seen successful entrepreneurs who have started their business on things like credit cards, or on things like getting a peer-to-peer loan using Upstart or using Lending Club, etc., using one of these other peer-to-peer lending sites. Even Kiva, as a minority business owner, or as a business owner who doesn't have ready access to capital, Kiva is also changing the game in the way that a business owner can get funding. You can get upwards of a $10,000 loan with Kiva in order to finance the expenditures of your business. And that $10,000 loan doesn't have any kind of an interest rate to pay back. So that's another way that I see some small businesses getting up there off the ground. These are not the typical startups that you would think of. I haven't heard of too many tech startups using loans to actually finance their business. This is more when we're getting into like e-commerce, or we're getting into very small businesses that way. But the final thing I want to talk about before I close out this video with why crowdfunding is also an opportunity, something that should be on your radar, is that many businesses are self-funded. And this is kind of a difficult subject, because I think many entrepreneurs out there are struggling with their finances. They're struggling with scraping together enough cash to actually get a product out there, to market it, to get eyeballs on it. It's a difficult thing, I readily admit it. Like, my first 2 years of business were very lean. Living in New York City, having to pay housing costs, having to pay my own costs. My own business, I was working a lot and living very leanly. So I understand that it's hard to self-finance a business, but I do think that this is something that if you are actually interested in starting something, you need to begin to put aside a budget of your own funds in order to draw on in the future. And that budget could be used for emergency expenses. related to the business, could be used for marketing. It doesn't really matter, but that's another way. Self-funding and reinvesting the profits is another major way that startups and businesses are funded today. Now the final way, which is my expertise, what I've been talking about for the last 5 years, what I've written 5 books on, what I've talked about extensively on my podcast, on this YouTube channel that I produce courses on. This is the subject of crowdfunding. And crowdfunding came more into the limelight, I'd say, around 2012, 2013. We started to see mega successful Kickstarter and Indiegogo campaigns. And what crowdfunding is great at doing is connecting the individual entrepreneur or the creator with a whole bunch of customers that are interested in owning the product. And they're supporting the initial production run of creating that product. That's the reason why people are supporting Kickstarter campaigns, is to own a copy of one of these products that the entrepreneur is wanting or has this passion to create. So crowdfunding is a great solution because number one, it gets you the funding. Number two, it gets you a massive audience, which can not only spread the word about your business and improve your brand, but it can also be a source of continual revenue. As you begin to create more products in the future, you can continue to sell them to this new crowd which you've assembled around your campaign. And number three, I think the reason why, to me, crowdfunding is a no-brainer, particularly for smaller businesses, e-commerce businesses, and I guess if you're a tech startup more with equity crowdfunding, the reason why it's a complete no-brainer for me is that it allows consumers to participate in the creation process. It allows them to, it's like if you're going out to eat and you go to hibachi and you're watching the sous chefs, go and cook and do funny fancy tricks and make your food in front of you. It kind of just gets you invested more in the process. And you're more likely to be an evangelist of a business or a brand when you've actually helped them go out there and make their product. You've seen how passionate they are. You've seen that company grow from a small seed stage into a larger business. You're a customer for life. And you can always think back to the time when you supported that initial production run of the product, and you're actually a part of that company's history. That's really, really freaking powerful. So I urge you, go and learn more about the funding type that interests you. I have some great articles out there on different funding stages, on the different avenues that I've just discussed. And finally, if you are interested in crowdfunding, I do have a great book on that, which goes into the launch formula that you can use to get funding on Kickstarter. So I will also link that up for you down below. Again, my name is Sal. I hope you've enjoyed this video. If you liked it, give me a thumbs up. Also, come subscribe to this channel if you want more videos like this. And finally, if you haven't already, go and check out some more videos that I have out there. There are lots of free educational, there's lots of free content, lots of free stuff for you to sink your teeth into and to really learn more about how crowdfunding works and different funding avenues that you can check out.